For every dollar of interest this trust owes, it only earns $3.80. That 3.8 times interest coverage might look like a small detail in a thick report, but in my forensic system, it is a hard gate failure that tells us the buffer for your retirement income is thinning. Today, I am putting the UOB Kehian BY call under the forensic lens because the analyst and I are looking at the same trust and reaching very different conclusions. I have been watching the logistics space in Singapore and Australia for quite a while now because the physical assets are genuinely impressive. But as I ran the numbers for this episode, I had to double check the data because what the buildings show you and what the balance sheet tells you are two very different stories. I want to share that forensic process with you today so we can see where the real risk is hiding. We are starting with a headline that every institutional analyst is leading with right now. 99.8% occupancy. It is a powerful number and it is doing a lot of heavy lifting to make investors feel secure. But behind that wall of full warehouses, the interest coverage is starting to crack. This audit is not about the 99.8% you can see. It is about the forensic pressure points that the press release naturally wants to skip. My job is simple, even if the balance sheet is not. I read the numbers that the headline skips, the interest coverage, the gearing, the free cash flow sustainability, so that the Singaporean building or living off a dividend portfolio gets the same forensic clarity that institutional money takes for granted. Let's look at what the institutional side is saying. Jonathan Koh from UOB Kehian is maintaining a buy rating with a target price of $1.30 Singapore. His core thesis is that the income paid to you, the distribution per unit, is on a recovery path. He believes this growth will be driven by very strong rental increases when existing leases are renewed across the logistics portfolio. There is some evidence to support that bull case. In New South Wales, warehouses are seeing rents jump by 71.7% upon renewal, which is a massive spike. The trust also recently added a $64.1 million logistics property in the Netherlands for immediate income. Plus, over 80% of the space Google left behind at Alexandra Technopark has already been committed to new tenants, though those leases only start in early 2027. Because of those moves, the analyst has raised his income forecast by 8% for financial year 2026 and 6% for the year after. But here is the load-bearing wall of that entire BY thesis. The assumption that logistics occupancy is so strong, it can absorb both the rising borrowing costs and the current weakness in the commercial properties. If that wall moves, the whole case for growth changes. This is where we move into the raw numbers of the forensic screen. The trust earns roughly 303 million Singapore dollars in operating profit, but it faces an annual interest bill of nearly $80 million. When you divide those, you get an interest coverage ratio of 3.8 times. In my books, the absolute floor for a retirement-grade holding is 4.0. This is a hard gate failure. The trust is not earning enough of a cushion to protect your dividends if things get bumpy. We also have to look at how sensitive this balance sheet is to interest rates. Right now, the borrowing cost is 3.2%. If that nudges up to just 3.5%, the interest bill climbs and the coverage ratio drops to 3.46 times. For a retiree, that is a household running low on its emergency fund. The income might still be flowing today, but the safety margin is disappearing. When we put it all together on the financial health checklist, we see a mixed bag. The yield of 5.9% and the gearing of 34.4% technically pass my thresholds. However, the interest coverage fails, and the commercial occupancy at 88.4% is well below the 95% mark I look for in prime assets. This puts the trust firmly into Zone 4, caution. Beyond the checklist, I am seeing 4 soft flags that demand your attention. First, the total debt is 7.8 times operating earnings, which is very high. Second, you are paying a 28.6% premium over the fair value of 77 cents. Third, we have dual occupancy failures in Singapore. And finally, there is a debt maturity wall coming in less than 3 years, meaning they have to refinance a lot of money very soon. Now let's talk about the dividend. The trust paid 2.95 cents per unit in the first half of the year, which is actually down 1.7% year on year. While the analyst expects a recovery, we have to look at the quality of that payment. Is the income coming from the buildings themselves, or is it being propped up by other financial maneuvers? The data shows the dividend is currently in support mode. They used $5 million from asset sales to top up the most recent distribution money that is not repeatable. They are also paying 75% of management fees in units instead of cash. This preserves cash today, but it dilutes you as a unit holder over time. To me, this says the organic income cannot yet stand alone. It is being coached through a transition. The gap between the analyst's buy rating and my caution rating comes down to our different time horizons. The analyst is looking at 12-month price appreciation and momentum. I am looking at the sustainability of retirement income. If you are paying 99 cents for an asset that has a 77-cent fair value and a failing interest coverage ratio, you are taking on a risk that the institutional reports often downplay. The big question for me is what happens if the recovery takes longer than the analyst expects? We have that debt wall maturing in 2.8 years. If those loans are refinanced at 4% or higher because inflation stays sticky, the interest bill will rise, and the whole story of a dividend recovery could quickly fall apart. We have to ask if the potential reward is worth that specific risk. When we compare Frasers Logistics and Commercial Trust to its peers like Capitaland, S-REIT, or Mapletree Logistics Trust, we see a sector-wide squeeze. Both of those peers have gearing above 40%, which is higher than Frasers. So while Frasers looks tidier on debt levels, none of these three industrial giants earns a clean forensic pass right now. The pressure of rising borrowing costs is hitting everyone. The entire industrial REIT sector is feeling the weight of the current interest rate environment. Frasers is not uniquely distressed, and in fact, its 34.4% gearing is the lowest among the big three. But a tidy gearing ratio does not cancel out a failing interest coverage ratio. All three of these trusts are facing the same pressure, and for an income investor, that means there is nowhere to hide in this sector right now. The analyst wants you to trust that the logistics side carries the whole trust, but the commercial side, the offices and business parks, is only 88.4% occupied. The new tenants at Alexandra Technopark won't even start paying rent until early 2027. For a retiree, that is not true diversification. It is concentration risk dressed up in a diversified wrapper. High occupancy in one room does not fix a leak in the basement. If this forensic breakdown has helped you identify a risk or calculate a margin of safety, hitting subscribe tells the algorithm that data-driven analysis of the Singapore market deserves a seat at the table. It takes 2 seconds, but it helps us keep this independent. The algorithm does not know you read every word. It does not know you checked the gearing ratio twice. It only sees one signal. If this analysis has ever helped you identify a risk or calculate a margin of safety, subscribe for free and share it with one person who needs to hear it. That one action tells the algorithm that data-driven SGX analysis deserves a seat at the table. As we look forward, there are 3 things you must watch. First, can the interest coverage ratio get back above 4.0 times? Second, will gearing stay below 35% if property values in the United Kingdom or Australia get marked down? And third, at what rate will they refinance that debt maturing in 2.8 years? If they pay more than 3.8%, the dividend recovery story is in trouble. Currently, you are being asked to pay 99 cents for something that carries a fair value of 77 cents. Paying a nearly 30% premium for a trust that is already failing its interest coverage floor is not a retirement-grade entry point. While institutional reports might treat refinancing risk as a footnote, forensic investors know it is a silent dividend killer. Right now, the buffer for error is very thin. Refinancing risk is something we have to take seriously because it can eat a dividend from the inside out. Institutional reports often assume everything goes smoothly, but we have to build in the scenario where it goes wrong. With the interest coverage already at 3.8 times, there is very little room to absorb higher rates without impacting the cash that goes into your pocket. My forensic stance is zone 4. Caution. The yield of 5.9% is decent, but the hard gate failure on interest coverage is a major red flag for anyone relying on this for retirement. This trust is not currently a sanctuary. The income is real, but it is being supported by non-organic mechanisms, and the balance sheet lacks the buffer I need to see for a core retirement holding. The logistics portfolio is genuinely high quality, and the rental growth is real. But you have to remember that this trust is in the middle of a pivot. You are not buying a finished, stable building today. You are buying a construction site with a very good architect. If you already hold it, this is a time for monitoring, not necessarily exiting. But if you are looking to enter, I would wait for the new leases to actually start paying. For your watch list, Frasers Logistics and Commercial Trust sits in an opportunistic role. The major catalyst to watch is the commencement of those new leases in January 2027. Until then, it does not meet my standards for active accumulation or for a drawdown portfolio. We stay in the watch list zone and keep a very close eye on that interest coverage ratio over the next few quarters. This content is for educational and informational purposes only. I am not a financial advisor. I am a retail investor sharing my forensic process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security. Stocks assessed under Iggy's forensic yield standard are benchmarked against a 4.7% minimum yield hurdle. All data is sourced from public filings and verified sources. Unverified data is explicitly flagged. All investments carry risk, including potential loss of principal. Past performance is not indicative of future results. If making decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MES licensed financial advisor before committing funds.